What if pension funds were not just managers of retirement money, but architects of a nation's economic future? In 2025, the UK government launched an ambitious initiative called Sterling 20. It unites 20 of Britain's largest pension funds and insurers with one shared goal: to channel long-term capital back into the UK's own infrastructure, innovation, and growth industries. For decades, British pension funds have pursued stability above all else, investing mostly in overseas bonds and global equities. That approach kept portfolios safe, but it also meant billions of pounds flowed out of the UK, leaving domestic startups, housing projects, and regional economies short of investment. Sterling 20 seeks to reverse that pattern. Its mission is simple yet bold: bring the money home to rebuild communities, upgrade infrastructure, and accelerate the rise of industries such as AI, Fintech, and renewable energy. The scale is extraordinary. Together, these institutions oversee about $3 trillion in assets, roughly W5,000 trillion KRW. Over the next 5 years, they plan to direct billions toward projects that strengthen Britain's physical and digital foundations. For instance, Legal and AMP General has pledged around £2 billion over 5 years to build nearly 10,000 affordable homes across the country. Other participants are targeting broadband expansion, urban regeneration, and clean energy development. Many funds have also reaffirmed their alignment with the Mansion House Compact, an industry commitment to raise the share of UK-based private market investments from just 0.6% today to as much as 5%. It's more than a numerical target. It represents a philosophical shift from merely protecting capital to deploying capital for national growth. This strategy draws inspiration from abroad. Canada's so-called Maple 8 pension model showed that domestic infrastructure and innovation investments can yield strong returns while creating jobs and competitiveness at home. Britain now hopes to cultivate a similar ecosystem, one where homegrown savings power homegrown industries. If Sterling 20 succeeds, it could fundamentally reshape how British capital circulates. Pension money would once again flow through towns and regions, funding housing, transport links, and next-generation energy systems. At the same time, technology sectors like AI and renewable power would gain patient, long-term funding, transforming Britain into a nation that fuels internal growth through internal capital. Yet ambition alone is not enough. One of the biggest hurdles is the shortage of shovel-ready projects. Even with vast capital available, few infrastructure initiatives are ready to absorb immediate investment. There's also the cultural barrier. Pension funds are inherently cautious institutions. Their duty is to preserve value for future retirees, so stepping into higher-risk, high-growth ventures requires new governance models and a deeper tolerance for uncertainty. And infrastructure investment is a slow burn. Returns may take years to materialize, while political cycles and public pressure often demand quick results. That tension could test the patience required for true long-term reform. Still, Sterling 20 is a meaningful beginning. It marks not only a financial collaboration, but a structural redesign of how Britain mobilizes its own wealth for national renewal. If pension funds can align with public policy, balancing collective benefit with sustainable returns, they can evolve from passive managers into active partners in the country's growth strategy. Success will depend on 3 gears turning together: strong policy support, effective project execution, and disciplined risk management. When these align, Sterling 20 could become the new heartbeat of the British economy. Sterling 20 is more than a name. It poses a fundamental question: can capital truly build the future of a nation? If this experiment succeeds, Britain may once again be known as a nation of investment, innovation, and renewal. And right now, the world is quietly watching how this story unfolds.